everyone, this is Ronica, tax advisor and CPA, and the question for this video is, which entity is the best for my real estate investment? And I think that even sometimes seasoned real estate investors are still trying to feel out these different real estate structure and how they should structure things. So the more properties you have, the more the structuring of it becomes something that you have to work out and you have to get right. But I will say an LLC, simple, boring old LLC, has been the winner for years. A simple LLC, if you have two partners, then your LLC will be taxed as a partnership. As you know, LLC is not really a tax entity. If you form an LLC at your state level, you'll be able to elect to get your LLC taxed whatever you want it to be taxed as. You can have it taxed as an S Corp, you can have it taxed as a C Corp. And if there's two partners, the default classification is a partnership, and you can also change that. But when you're a real estate investor, you want to keep it to be that LLC with no elections. You want, if there's two persons or owners in your LLC, you want to keep it as a partnership, that type of entity. If you have several properties and things like that, then that's when you can get into structuring a holding company that holds all your separate LLC properties. Or how should I say that? You'd have a holding company that holds all the separate LLCs that hold your real estate, or what combination that you come up with your attorney, right? What you need to stay away from is a corporation. You don't want to have your LLC taxed as a C corporation, and you also don't want to form a C corporation to hold your real estate holdings. This becomes, a big problem. There's less flexibility to transfer properties. You never know what can happen. You also get into double taxation. And remember, one of the goals of real estate is to get your tax down as low as possible and benefit from the really great benefits of having and investing in real estate. So you don't want to get yourself into a higher tax rate, or your investors in a higher tax rate, by basically forming or electing to be taxed as a corporation. So you want to stay away from that. Also, if you have to transfer, it's very easy to have a capital gains event in a corporation even without selling the property, like transferring the property. For whatever reason, things happen. Sometimes business has to transfer a property and things like that. That can create a taxable event in a corporation. Refinancing and things like that can create a big taxable event in a corporation. So you always want to stay away from that and make sure that you examine the differences between the different entities before you start buying real estate in any entity, so that you can understand the tax implication for these entities. And as I mentioned in my previous videos on this real estate topic, and I'm happy that you guys are liking this topic, and it shows that real estate is still alive, even though the market is crazy right now. It's still alive and well, and people are continuing to invest. Let me know any additional questions that you may have, and also continue to check out my blog article, the 5 most powerful tax benefits that you can get from your real estate investment, and that basically maps it out for you, so that can guide you in the way your mind, or what you should be thinking of when you're trying to build your real estate portfolio. That's it for today. Have a good day.